Good afternoon, everyone, and thank you all for joining in. I am Aditya Sharma, Vice President at Novel Patterns, and I am joined today by Shubham Chaurasia, who is our lead data analyst. So today's session is titled as Beyond the Post-Disbursal Blind Spot, Detect Loan Stress Before Delinquencies Begin. Over the next 40-45 minutes, we are going to unpack exactly what that blind spot is and why it is costing lenders more than what they actually realize, and how a fundamentally different approach can monitor it and can reduce it to a greater extent. A quick housekeeping note before we start. This session is being recorded, and we will probably send the recording along with this deck, which we are presenting to everyone who have registered. Please drop in case you have any questions in the chat as we go. We'll pick up a throughout, and also we have reserved a specific slot towards the end of the session for Q&A. Let me just quickly walk you through the agenda for today. So we'll tell you what is going to unfold so that you know what is going to happen, what you can expect, and when. So we'll start by unpacking the post-disbursal blind spot itself, the actual industry data behind the stress in unsecured lending, why the traditional early warning systems keep missing it despite everyone's best efforts, and also a real concrete example of what exactly happens wherein that blind spot costs more than the institutions expect. From there on, Shubham will take it forward and probably going to take you through Hawkeye, how it is actually built, how it thinks, and probably the specific mechanisms that let it flag risk even before the account is still fully functioning and even before a payment is ever missed. We'll then take you to a full 15 minutes live demonstration on a real portfolio view so that you can actually see it working rather than just hear us describe it. And then I'll close things with probably what it actually means in terms of business outcomes, whom it is built for, and eventually we'll open the space and the floor for your questions. One more thing before we start, there'll be a quick poll during the session. So keep your eyes on the screen. It will just hardly take a few seconds, and we'll share whatever the room thinks in the real time. So if you look at probably the industry, which is banking and financial industry, specifically in India, everybody has become great in underwriting. We have spent a lot of time, technology, and effort in becoming great at underwriting loans. Equally, everybody has become great in also collections, but after delinquency. But there's still a blind spot and a lot of gap which we usually see between those two stages. And that blind spot is where profit, quietly disappears. So let me make it very obvious and very clear that today's discussion is not about collections. It is also not about NPA management. It is about preventing those accounts from ever becoming collections cases in the first place, because the cheapest accounts are probably the ones wherein the account never defaults. So those are probably the easiest accounts to recover. So quickly telling it to you what is currently changing in the industry. Portfolios are becoming more complex than they were probably a couple of years ago. There are more new products, more new segments, more disbursal channels. Similarly, the borrower behavior is being shifted as well. There are now more gig incomes, there are more credit lines, and there are more informal cash flows that really never shows up on a bureau report. And also adding regulatory pressure to it, which always keeps on pressurizing towards early risk identifications, and most teams are still monitoring the same with manual processes which probably we have built 5 years ago. It is not that none of us are doing something wrong. It is just that the tools which are currently available in the market have not just kept in place. So I'll just quickly make this more concrete with probably a live example so that you would probably be able to relate it better with a real life problem. So if you look at probably how the lenders historically look at a zero default signal. So if you probably look at the current landscape, so you don't even actually know until a default signal comes that is there something which is going to happen to an account. It is not a weak signal. It is not a delayed signal. It is actually a zero signal that you today get. So similar on the similar lines, I'll just quickly take you probably through a credit card story. So let's say there's a new credit card 60 days into its life. Day zero, the credit card is being issued. The bureau looks very clean. Day 20th, nothing exactly wrong on papers, but the spending behavior has started to shift. Now, this is the exact moment wherein Hawkeye would have flagged it. Now, moving on to day 35, wherein the customer is still paying the minimum due on every month, but still nothing concrete on papers. Day 50, still no alert, but the cash advances keeps on climbing. Now comes the day 60, wherein there's still the first EMI missed. This is when an entirely separate clock starts, the default clock, up until there was actually bank had received zero signals. And I think Hawkeye flagged this probably on day 20th, which is 40 days before the default clock ever start to tickle. So I think that's the difference between a phone call, which could eventually help you to probably restructure a loan or probably a collections process that started adversarial. Now, if I probably talk about some of the numbers, because the story that I just mentioned is just not an edge case. 53% of the retail loan slippages today from unsecured lending, even as a headline bank, NPA sits on a multi-decade low. 80% of the alerts from the traditional rule-based early warning systems turns out to be false positive. Similarly, if you probably look at microfinance as an industry, so early stage delinquency in the microfinance institutions are up to 163% year on year, and so are the credit card asset quality, which keeps on rising 2.3% and over. Now, here's what the structural reason why. If you probably look at the lenders today, everybody has classified the segmentation of risk as standard, SME0, SME1, NPA. So every category, what you see here is reactive by design. DPDs, EMI bounces, cash collections, bureau refreshes. They are all the indicators which shows an evidence of what has already happened. The industry has extremely become good in order to define what is happened and become great in measuring what has happened yesterday. And based on this, I usually ask a lot of CEOs questions of how much have you spent in underwriting or probably before the disbursal of a loan? Have you spent the equal amount of time and effort in also understanding the customer post disbursal? Because I think lending is something which is not just one at origination. It is one throughout the life of a loan. Origination, I would probably say, is just probably the starting of the relationship. Again, while having some of these conversations, a lot of lenders usually comes up with, you know, we already have a bureau monitoring. Absolutely, you have a bureau monitoring, but bureau would tell you what has already happened. But Hawkeye would eventually tell you what is beginning to happen or what is the customer beginning to do. I think these are two fundamentally different things. Bureau data usually lags real repayment behavior by weeks. It refreshes monthly at best. And also, it reflects only the credit obligations, not the live cash flows or probably the spending behavior. Similarly, if you probably talk about your core banking system today only gives you transactions. Now, what Hawkeye does is Hawkeye converts those transactions into intelligence. And I think that's the core difference. And that's what's the philosophy behind building Hawkeye. So today we are monitoring collections. Today we should monitor cash flow because collections will tell you what happened and cash flows will eventually going to tell you what's going to happen. Now, before I hand it over to Shubham, a real quick question from this room. How many of you eventually believe that your current early warning systems are truly early? Because even if your systems only alerts you after the first EMIs is missed, is it really an early warning system or probably it's just an early recovery system? So that's exactly the question on your screens. If you could probably spot stress before day zero of default, would your default numbers meaningfully improve? Please take a couple of seconds to probably help us vote, and we should be able to probably share you the responses in real time. Handing it over to Shubham to probably take it up from here.
Starting from the real challenges, real problems we face, we as analysts face. We have millions of transactions, we have a lot of features to cover, and there is some stress, there is some signal, there is some intent hidden in that particular transaction set. This is very challenging for an analyst to decode all of the transactions and combine it into one stress signal. So looking from the analyst point of view, I'd like to share the challenges and how Hawkeye works in order to overcome those challenges. First is the feature explosion. There are thousands of features. Some are used by, some are used pre-lending, some are used for monitoring. And when we look at the transactions, we can derive many of them. And manually synthesizing them into one clear risk profile is humanly impossible. Another main issue is the black box gap. We use AI models, we use functions, and try to, they intend to give the results which we as analysts cannot even justify. This is a black box gap. What we do, we'll talk about this in detail further when we are in the demo. How we solve this explainable AI. We try to redefine the limits in this challenge. And another is a constant pain of tweaking static thresholds. We, in monitoring, which is used traditionally, we try to just set some thresholds on some particular features and which fail on different sets of data when we have multiple products working in our single portfolio. That is the pain we truly feel. And these are the challenges we try to overcome in Hawkeye as a product. So, what does Hawkeye do? This is the same ladder Aditya talked about. When all the loans are performing good, they are performing normally because we are just dependent on the bureau reports. But among the transactions is where the true behavior lies of a customer. Too much dip in liquidity. We can have early signs of delinquency in the transactions itself. But what we do, we wait for bureau reports, and what that is what we lack. This is a tooling problem. So what Hawkeye does, it detects the shift in the behavior of the customer pre-lending and post-lending. So 800 behavior, around more than 800 cash flow parameters and behavior constantly monitor a particular customer. Deep dive into the transactions and look for anything that is unusual in terms of activity that interprets the true behavior of that customer. And whenever we have such an alert, that alert is propagated to the relationship manager so that the risk can be mitigated, the strategies can be made, the overall strategy to target a particular product can be restructured. So this way, what we try to do is shift the entire functioning of the post dispersal plans from reactive to proactive. Meet Hawkeye here. Hawkeye does what? It, again, as I told, it works on about more than 800 cash flow parameters and features, which are working in the real time and arranged in a 5 layer risk architecture. This 5 layer risk architecture we'll see in the demo itself. And when there is something unusual in any kind of, in any customer, a customer from any kind of segment, might be salaried, might be non-salaried, might be a gig worker, etc. Or we can say that from a different product, a gold loan customer and a home loan customer and an unsecured personal loan customer might behave differently. Everything is being covered in this functioning of Hawkeye, and the RM is alerted day before the day zero of default. We are not waiting for default. We are not waiting for any delinquency. We are going to show you the stress a customer is holding, which is lying somewhere in the transactions the the day before zero of default. Since we are processing 600 million, over 600 million transactions per month. So, what are the key challenges we as analysts, or we can say, what are the key challenges in the industry regarding to the monitoring side? The traditional EWS are kind of rule based. We wait for the monthly reports, bureau reports, whether the customer has bounced an EMI or not. We detect the stress after the condition has already been deteriorated. This is not we want. We have we And there is another side of the challenges, which is sometimes we get uh, I can say high false positive rates, which is due to the breaching of our thresholds, but the context awareness is missing, and that is what our key feature is. And the bureau dependency gets reduced. We have AI driven intelligence, continuously monitoring, and context awareness. This is what we'll talk about. So how Hawkeye works, the overall workflow is like a loan is disbursed day zero. Somewhere along the way, the customer behavior changes, the spendings increased, the income slightly gets reduced. The combination of those features, the velocity, the momentum it holds in the transactions, we get that in our data. Since we try to read each and every, take into consideration all the transactions of a particular customer, of a particular loan segment, and then our model, our AI structure, a hybrid of models, tries to detect the hidden stress. And as we detect the stress, the risk, there is a risk score we try to give to the customers, which are run on our Hawkeye. And that updates the RM, the relationship manager, and hence the strategies can be made so as to mitigate the the warnings we get. Key capabilities of the Power Smarter Loan Monitoring. We have behavioral intelligence, not post delinquency. We monitor the behavior of the customer pre lending and post lending. We try to shift the energy towards monitoring the behavior because the intent lies in the behavior only. We give the risk scoring, we monitor the whole portfolio. No matter what the customer segment is, no matter what the product is, we take everything into consideration. We treat every of the segment or the product differently, and we even help to suggest the best steps of mitigation for the relationship managers to take whenever we have a sign of delinquency. So what is the context awareness I was talking about? Here we work on the CPD engines, the change point detections. We look the customer based on his uh, own behavior, might be salaried or non-salaried, and we try to catch the customer's baseline behavior pre-lending, which was shown, and try to check whether that particular behavior is maintained. So the change point detection works here. We 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 try to aggregate the stress which is uh, distributed in multiple accounts. For a single application ID, we can have multiple bank accounts. The bank accounts might be different in nature, but we try to incorporate everything in order to give one single stress score to a particular customer. That is what we do. And a very important key point in the sense of context awareness, I can say, is we try to have not only judge a customer based on his previous transactions, but also what is currently happening in this industry, also what is currently happening in the sector. So if I can see, if you see, we have a 15% of cash flow dip somehow. So that does not. That might be a signal of stress for a particular segment or a particular product of the bank. But when I try to have a holistic point of view over it, like if that kind of behavior, that kind of dip is experienced by the whole sector, the other customers which are lying in that particular sector or not, this is the context awareness we're talking about. So we try to have a holistic monitoring, not just some rule based or scale based. So we try to replicate rather than replace. We believe that a senior officer's qualitative gut is very good while encoding the human judgment. So we try to automate those logics. We try to give intelligence in our system so that acts as your co-worker, human co-worker. Hawkeye works as your co-worker. It gives you the stress. It tells you whether the customer is stressed or not, in which aspect the customer is stressed, what are the most probable steps you can take. All these things are being covered in this. So I guess now it is the time when we move directly to the exact demo where I'll show you how Hawkeye exactly works. So when this is the first level view a risk officer or a risk analyst would see when they come to Hawkeye, when they log into Hawkeye. This is that dashboard we are talking about. You can see there are some customers here who are being monitored, and you can see they come with some flags, amber or green. I'll tell you about them. But first, I'll try to tell you that KD Printers is someone who is from retail lab product, lab secured. There are vehicle loans we are trying to monitor. There are personal loans we are trying to monitor. There are home loans we are trying to monitor. So out of these, this is my portfolio. We can see the number of customers who are moderately. So first let me tell you what these green, amber, or red flags interpret. The green flags interpret that the customer is safe, that the customer is keeping the behavior which it was keeping pre-lending, and the post-lending is similarly. So nothing is to be afraid of. But let me let you all go through this particular example. For say, Mr. Arun Sharma has been flagged as amber. Why? He has a personal loan. So let us review this particular section. So as we can see here, in just a few clicks, I can really understand what exactly is going on with this particular customer. This particular customer, first of all, I can say that we have a signal per customer or per application ID. Then we can deep dive into what exactly changed uh, in Arun Sharma's behavior, that we tried to signal it, that we tried to flag it. So we try to distribute our point of views. Like in the transactions only, we can have some balance point of view, like in where we can see the liquidity, how liquid is the customer's profile is. We can see the incomes or the salaries, where we can try to tell whether the income is whether the income is being held normally, or whether there is some external seasonal or funding reliance. Is the cash flow too tight? Is the counterparty risk, is the customer is not holding any kind of counterparty risk, any kind of gambling transaction? So we try to incorporate everything here. So if I try to look for the exact reason why Arun Sharma was flagged, so we can see, say, we try to open the external seasonal funding reliance as point of view, then we can see that there are a lot of red flags here. And if we try to look at the evidence side, we can say that this is this is the exact transaction what led to the red flag, what led to the amber flag, what led to the stress signal update. Tata Capital Limited, a loan of 1 lakh to 1,29,016. A new Tata Capital Limited recording a volume shift representing a baseline compared to previous range. So in the previous range of data we had for Arun Sharma, he did not have any loan. But after the loan has been disbursed, we see that another loan has been disbursed. So this is the risk factor that is involved in this particular customer, and hence we tried to flag. So this was the 5 layer architecture we were trying to propagate to you. A customer is flagged, which aspect is stressed, in that aspect which feature is stressed, and what is that particular transaction that led to this. This is our try to redefine the limits in the explainable AI black box I was talking about. So we can also, for as per the mitigation point of view is concerned, we can also try to export my whole portfolio and then send it to the mitigation officers, and where we can have you know the details of all the customers, whether they are amber on a particular date, and hence our mitigation strategies can be made. So this was all about Hawkeye, what Hawkeye does, and how does it really gets into the transactions uh, in order to take out the exact behavior or the stress that he or she is holding within those transactions. We do not have to wait for the bureau reports and so I guess now I'll hand it over to Aditya to share the P&L impacts of the same.
Thank you so much, Shubham. And adding on to what probably Shubham has just mentioned. So it is just not that we try to capture the transactions and then give you stress signals. We also work on multiple different behavioral models, which also are helpful just not to identify the capacity, but also to identify the intent and behaviors of the customer. And the platform probably is just not something which is only limited to collection use cases, but it is something which could also be used for a lot of other use cases. For example, upselling and cross selling. We've seen this with a couple of banks that they were running a microfinance portfolio on their books. They've identified some of the customers probably which were probably the best customers in their microfinance portfolio. They ran Hawkeye for a couple of months on their portfolio of those individual customers, and then eventually try to understand the behavior, intent and capacity of the customer using Hawkeye, because Hawkeye would also compare and reconcile the data of the previous months as well. So you just don't get the data of the current day, you also are able to compare the data across the previous months as well. So it gives you multiple different identifications in terms of what has improved, what probably has deteriorated. For example, there's a customer X, his salary probably might would have increased, but at the same time his spendings also would have increased. Similarly, I'll give you a very small example. Let's say for a tier 2 city, maybe I would say Jaipur, a rental of 35-40,000 probably looks very high, but the same kind of rental for a place like Mumbai is very nominal. So it just does not based on static rule based signals which says if the spending is more than 30,000 rupees it should flag me as high risk. Rather, it takes multiple different parameters and based on your behaviors, based on the geography, based on what demographics, based on the segment of customers, it eventually runs and gives you the output. So probably if you look at two customers with same salary and a same bureau score in an early warning system, you probably would get the same output as these systems are rule based. But probably if you ingest the same data in Hawkeye, you would get a very different score, since Hawkeye just does not only work on static data parameters, but it runs explainable AI behind and gives you an output which eventually makes the data more intelligent and more meaningful. Now, a quick question of who eventually will be the end user of Hawkeye and who would eventually be using it. So I think a lot of banks and NBFCs running large retail books, HFCs with a lot of self-employed borrowers, wherein the bureau line is the thinnest. Of course, for P2P platforms as well, wherein, there is a very thin file borrower with probably zero to almost nil repayment history to lean on. And especially for the people who have felt this more directly, the portfolio monitoring teams, the relationship managers, the risk teams who are genuinely trying to build a more cash flow driven NPA prevention. Now, again, what probably are the business outcomes in terms of what we have seen the numbers from the industry? So early detection from 30 to 90 days before day zero. I think that's the day 20 versus day 60 gap from our story. Remember the poll, 72% of you already said that, this would move the needle up. If you talk about the current industry landscape, up to 70% reduction in manual monitoring, 40% fewer false positive, and of course, faster collection prioritization, and of course, at the same time, lower operational cost. So these are probably just illustrative ranges which we have probably taken from the industry data. and we would probably be more than happy to validate this pilot on your books. But I think the mechanism is something which is just not a projection. It is something which we've seen in the industry. Now, as we move forward into the lending industry, we have seen, lending is now entering into its third evolution. Probably a couple of decades back, if you look at it, lending 1.0 was more of a collateral based lending. Then, probably the last decade, or probably the last 8 to 10 years, we had seen, the lending is more score based. There are multiple different parameters. You eventually run those rules and policies, and then you generate a score of a customer, and then eventually lending was more score based. But I think as we move forward, the lending 3.0, which is going to be the future probably from now, is something which is a behavior based lending, and behavior is now becoming the new credit score. If you probably look at India as a geography, India is one of the richest digital financial ecosystems in the world. We have API or UPIs, we have account aggregators, we have digital banking, we have real time payments, we have open finance. And for the first time, we will have the lenders will also have an access to a continuous financial behavior of a customer. And to be honest, I don't see, that data is going to be an advantage going forward. The intelligence is something which is going to be the future. And what we have seen is that the winners probably in the future would not be the financial institution with the most data, but I think they will be the ones who would get or probably generate the best decisions from it. Because the future of lending probably won't be defined by who lends the fastest, but I think it will be defined by who understands the borrower behavior at the earliest. And I think that's the philosophy behind Hawkeye. So I think that is all what we probably wanted to present and showcase it to you. Just a quick thing. We are happy to probably take any questions. If there are any, we would be more than happy to probably take this up and answer it. We'll probably take a couple of questions. And there's also a QR code. You can just scan this or probably reach out to us directly in case you want to probably set it up and probably want to see it on your own portfolios. We'll be happy to do that. Please feel free to drop in any questions in case you have any. Else, we have received a couple of questions probably once we shared our webinar link. So I'll probably take a couple of questions from there. So I think one of the most commonly questions which were usually asked during our interactions for Hawkeye is how it would work, from where it would probably get the data. So I think, Tanmay, I'll just probably finish the answer and then probably, let Shubham take that question which you've just posted. So Hawkeye, there are mechanisms wherein Hawkeye could take data from multiple points, or there are multiple different data sets from which Hawkeye usually gets the data. But I think the ideal thing for which the philosophy behind which Hawkeye was built is through account aggregator. So once we are in the journey of originating a loan, we usually take the one-time consent as well as the recurring consent from the customer, and which eventually help us to automatically get the data directly from the account aggregator on a monthly basis on a customer. Just for all of your information, RBI allows an NBFC to probably get or fetch the bank statement of a customer who is a standard customer at least for 5 times in a month for a non-NP account. So we already have that consented data from the customer, and we just try to fetch that data directly from the banking. Shubham, I think there's a question from Tanmay. You probably can take that up.
Hello, am I audible?
Yeah, Shubham, you're audible.
So, as far as I guess Tanmay asked, how do you ensure explainability and regulatory compliance of AI-driven stress prediction models? So, as far as the prediction of the stress is concerned, we have a workflow where we work like we have a consent driven, as Aditya said. We have the customer's data getting into our systems, and then we try to then for all the customers that are being that are being ingested into the Hawkeye, we try to segment and segment based on what account types they are, and try to segment on what product types of they are, and from that we can have that particular peer or context awareness, and the context awareness synthesis in terms of stress signal analysis, and then we feed those to our AI models, and then they are you know generating this stress regarding those particular customers.
I think there's one more question which we've received. How relevant this is for semi-urban or rural customers, those not very much exposed to digital infrastructure. So I think, Gaurav, when we were probably trying and tested this, and as I gave the example of the microfinance institution, so this use case probably is just not limited to collections, as I told before. This might create a greater use case for cross sell and upsell as well. So, for example, now as a policy of a lot of financial institutions, you need to open a bank account before we eventually disburse a loan. So what we've eventually done is probably from the time the customer has a bank account and probably he's doing banking with you, we keep a track of his banking data. And, based on this, it could help you to do proactive collections rather than just, making sure that you don't follow just the reactive approach. And also a lot of use cases across upsell and cross sell. But probably if I talk about on a number side on a semi-urban or rural area, we have seen probably penetration around 57% today in the tier 3, tier 4 markets, which is comparatively low if you compare to probably tier 1 or tier 2 cities, wherein the penetration in terms of digital infrastructure is more than 83% today. So I see there are no more questions. So thank you once again, everybody, for joining in. I think it was a great session along with all of you. Looking forward to probably have this piloted on your own portfolios so that, we can eventually deliver a lot of value and then, eventually can see Hawkeye running live on your portfolios so that, we can drive basically meaningful intelligence behaviors out of your own portfolios. Thank you once again, everybody, for joining. We'll share this entire recording as well as the deck with all the people who have registered and attended the session. Thank you, everyone, once again.